Today was a decently quiet day in the market. And by quiet, I mean volatile, but within a very tight relative range. So nothing too crazy going on. We did spend a lot of the day in the red, though, basically the entire day for the S&P 500. And there's an interesting reason for that. You know, we got cooler than expected PPI. Some might expect that, and historically that has been the case during this inflation battle of the Fed increasing interest rates, that might cause the market to actually be green. But let's not forget, we also got some additional banking stress news this morning, with PacWest saying 9.5% of their total deposits fled last week. That's a lot. That rate better not continue. And my assumption is when people see that stock down 30%, it might. It just might. It seems like every couple weeks there's another bank or two banks that come under scrutiny. And this is picking up because it was very slow. It started with FTX, then it was Silvergate, then it was SVB and Signature Bank. Okay, that was a bit of a pocket. Then it was FRC. Now there's a couple more. I'm not saying this is a huge concern fundamentally. I really don't think it is. I think some banks didn't lend out so much money when interest rates were super low, and some banks were very aggressive lending money out when interest rates were super low. And today, it was either Kashkari or Waller directly addressed, I think it actually was Waller, the idea of overinflated asset prices. Let's not forget, when yields are low, bonds are very expensive. It's very difficult. It's very expensive to lend out money. Interest rates are so low, there's a lot of supply for lending and not nearly as much demand. So that was the case. You know, at one point there was a lot of supply for lending. There was, a lot of people buying bonds and interest rates being low and Fed funds being zero. So that's not an option. And you've simply seen a pullback in the debt markets, and that's going to lead to some banks going under. So I don't necessarily think banks going under, ceteris paribus, all else equal, is a huge implication for the economy, but it's going to put fear into things, and we'll see what happens. As long as deposits are safe, in my opinion, as long as deposits are safe, the economic impact, ceteris paribus, is very little. However, the Fed is continuing to raise interest rates. Banks are concerned about the economy. That gives them reason to tighten lending standards. And we'll see how that plays out. But so far, banks might go under. And the point here is it's unclear what the market reaction to that's going to be. Today, it was red in part because of that. The other part might be cooler than expected PPI. Okay, that's kind of a recession sign. And it also re-accelerated from a previous monthly decline. Notable, but I don't know how big of a deal that is. It seemed like kind of a non-event, and then the banks, that combination wasn't so good. But where does that leave us? Because we're very much in a sideways market. Where that leaves us is in a sideways market with very expensive mega cap tech that hasn't necessarily been sideways. Apple has been sideways since earnings, but overall the trend is up and up strongly. And look, I like tech products, but stocks can't go up forever. I get it. Apple's buyback is not small. They are buying back a notable portion of their shares, but their earnings and their revenues are not only not declining, but they're contracting. So that has to be weighed with that fact, very important fact, particularly when we came from such a Goldilocks environment and we're trying to assess what a more normal environment is going to look like again, because the previous more normal environment we were in with Apple was an environment that had lengthening iPhone cycles. That was the case in 2019. The time between your previous iPhone purchase and your next iPhone purchase was getting longer. Now, there's plenty of positives, international expansion, services revenue, plenty of positives, but we still got to evaluate things. And I don't know if the place to evaluate things is necessarily all-time highs in a Goldilocks environment with incredibly low interest rates. That's my take on it. So I think the rest of the market is beginning to reflect the earnings picture, which is earnings have declined. Not as badly as some may have feared, and I'll grant that. But like I said yesterday, a lot of that is realized now. Okay, Q1 was actually a solidly strong economic quarter. That's why the Fed is continuing to be tight. So I think a lot of the good news is priced in. We're clearly in a flat range here for much of the market. I don't know how long that's going to continue. I advise accounting for that fact in your positioning, that doing anything with time, particularly options, has proven to be a difficult strategy in this environment and will probably be so for the foreseeable future. Obviously, a downside catalyst can come, and one of the biggest possible downside catalysts is not too far away, being the debt ceiling. Now, I don't know how big of an impact that's going to be. Very unpredictable. They could come up with a deal tomorrow, or they can push it to the last minute, or they can do what Trump said, which seems to be what the Republicans do because he is Trump. And I'll leave that at that for now. And that is threaten default. So that would be a big deal for everything. And that would really affect the stock market. So in a big way, yields would go up, most likely. If the risk-free rate of return suddenly is not so risk-free, right? So, yeah. Anyways, it's a quiet day. We'll see how things materialize over the next few days. But overall, I think mega cap tech is continuing to run. I think it's expensive. If that area of the market breaks, that's when the market breaks. But as of right now, it's not really doing so much. So maybe this is the end. Maybe this is the top. I can't say for sure. But we're going to have to see what happens. So that's today's video. And until next time, peace out.